Imagine sitting across from a financial professional, or maybe it was someone at a dinner seminar or a friend who just got licensed, and they slide a piece of paper across the table. It shows a chart, your money growing steadily, market linked returns, zero losses, tax-free income in retirement, a death benefit for your family, and on top of all that, no contribution limits. It sounds almost too good to be true. And for a lot of people who bought that policy, it eventually turned out to be exactly that.
Oh, wow!
Today, we're talking about Index Universal Life Insurance, or IULs. And I want to be clear right from the start. This is not a hit piece. IULs are a real financial products with genuine advantages for the right person and in the right situation. But there are also one of the most frequently misrepresented products in the entire financial services industry. And the gap between how they're sold and how they actually perform has derailed a lot of retirement plans. So today, we're going to look at both sides. What agents get right, what they consistently leave out, and how to protect yourself if you're ever in a room where someone is trying to sell you one of these. Let's get right into it.
This is Kingdom Cash Flow. Here is your host, Mae Dungo.
Let's start with the basics, because a lot of people who've been pitched an IUL don't fully understand what they were actually being sold. An Index Universal Life policy is a permanent life insurance product. That means it's designed to last your entire lifetime, unlike term insurance, which expires after a set number of years. Every premium you pay does two things simultaneously. It funds a death benefit that pays out when you die, and it builds a cash value account that grows over time. The index part refers to how that cash value earns interest instead of a fixed rate. Your growth is linked to a stock market index, typically the S&P 500. If the index goes up, you earn interest, usually up to a cap. If the index goes down, you earn zero, not negative. That floor is a genuine feature, not marketing language. Your cash value won't shrink due to the market losses. The universal part means the policy is flexible. You can adjust your premium payments and your death benefit within certain limits. That flexibility sounds attractive, but as we'll see, it's also where a lot of policies quietly get into trouble. So, permanent life insurance, market-linked cash value growth with downside protection and flexible premium structure. That's what you're buying. Now let's talk about what agents emphasize and what they tend to skip over. Let's be fair. There are two things agents tell you about IULs that are genuinely true and genuinely valuable.
Oh my God!
I want to give those their due before we get into the harder conversation. Benefit 1. Tax-deferred growth with tax-free access. The cash value inside an IUL grows without being taxed year by year. And when you access it in retirement through policy loans, those loans are structured to be income tax-free. That's a real advantage, especially for high earners who've maxed out their 401ks and Roth IRAs and are looking for another tax advantage bucket. Unlike annuity withdrawals, which are taxed as ordinary income on the gains, IUL loans don't show up on your tax return as income. For someone in a 37% bracket, that difference is significant. Benefit number 2. No contribution limits. A Roth IRA caps your annual contribution at a few $1,000s. A 401k has limits too. An IUL has no government-imposed contribution limit. You can fund it as aggressively as the policy allows. Yeah! Which makes it attractive to high-income earners who want to shelter more money from taxes than traditional accounts allow. Benefit 3. Downside protection. The floor, typically 0%, means a market crash doesn't erase your cash value.
Yes!
In 2008, when the S&P 500 dropped roughly 37%, an IUL policy holder credited zero, not at loss. That protection is real, and it's one of the genuinely differentiated features of this product. Benefit number 4, the death benefit. Your beneficiaries receive a tax-free payout when you die. In a well-structured policy, that death benefit can be substantial, and it passes outside of probate directly to your named beneficiaries. If legacy planning is important to you, that's a meaningful feature. Benefit number 5, creditor protection. In many states, the cash value inside a life insurance policy is protected from creditors. For business owners or professionals in high liability fields, that protection can be a genuine planning advantage. These are real benefits. They're not fabricated. The problem is not the agents lie about what the product can do. It's that they routinely underemphasize or omit what can go so wrong. So here's where we get into that part of the conversation that tends to get left on the cutting room floor. Hard truth number 1. The cost of insurance rises every year, and it can quietly devastate your policy. So every year, the insurance company charges you for the cost of providing your death benefit. That charge is based on your age and the amount of coverage you carry. And it increases every year as you get older, in your 30s and 40s, but by your 60s and 70s, the exact years when you want your cash value compounding aggressively to fund your retirement, the cost of insurance can become a serious drag. If your premium payments haven't kept pace with the rising internal charges, the insurance company starts consuming your cash value to pay for coverage. And if that cash value gets depleted fast enough, the entire policy lapses. You lose your coverage, you lose your cash value, and depending on how your loans were structured, you may face a surprise tax bill on top of it. This is not a rare edge case. It's one of the most common ways IUL policies fail, and most illustrations don't model it honestly. Hard truth number 2. The illustrations are almost always best case projections. When an agent shows you an IUL illustration, that chart with your money growing beautifully for 30 years, ask them one question.
I want to ask you a bunch of questions, and I want to have them answered immediately.
What interest rate assumption is this built on? Many illustrations are run at or near the maximum crediting rate the policy has ever achieved. They're not lying. The policy could theoretically earn that rate, but crediting rates are not guaranteed. The cap rates the insurance company offers, the ceiling on how much you can earn in a good market year, can be lowered by the insurer at any time. They're not locked in for the life of the policy. An illustration built on a 7% average crediting assumption over 30 years looks very different if the actual average comes in at 4% or 5%, especially when insurance costs are rising simultaneously. Always ask to see an illustration at a more conservative crediting assumption. If the agent resists that request, that's your answer. Hard truth number 3. The flexibility can work against you. Universal Life's flexible premium structure is marketed as a benefit, and in the right hands, it is. But that flexibility means there's no fixed requirement forcing you to fund the policy consistently. Many policyholders, especially during tough financial stretches, reduce or skip premium payments, and because the insurance charges keep running regardless, underfunded policies slowly deteriorate.
Help me! I'm dying!
The policy is not calling you to warn you. By the time you notice, you might be years into a slide toward lapse. With a term policy, you either pay the premium or the policy ends. It's obvious. IUL's flexibility hides the deterioration until it's severe. Hard truth number 4. The loans aren't as simple as they sound.
Damn.
The pitch. Tax-free income in retirement through policy loans is technically accurate but leaves out important context. When you take a loan against your policy, the insurance company is lending you money and charging you interest on it, typically 1 to 3% annually. Meanwhile, your cash value is still being credited. If the credited rate exceeds the loan interest rate, a wash loan, the strategy works cleanly. But if credited rates drop or loan rates rise, the spread shrinks, and the loan can start creating drag on your cash value. Poorly managed loan strategies in late retirement combined with rising insurance costs and potentially lower credited rates can trigger a lapse. And a lapse with outstanding loans can generate a significantly taxable event at exactly the moment you can least afford it. Hard truth number 5. The commissions are very high, which affects who gets sold what. IUL policies pay some of the highest commissions in the financial services industry, often 70 to 100% off the first year's premium, plus ongoing trail commissions. That creates an obvious incentive structure. An agent who earns $8,000 placing a single IUL policy has a very different motivation than a fee-only advisor who charges $300 an hour. Regardless of what you buy, that doesn't mean every IUL sale is driven by commission. Many agents genuinely believe in the product, but it doesn't mean the bar for objectivity is lower in this space than in almost any other part of personal finance. Always understand how your financial professional is compensated before you take their recommendation at face value. So I want to spend a little extra time on the illustration issues because it's the single most important thing to understand before sitting across from anyone selling an IUL. Regulators have actually tried to address this. The NAIC, the National Association of Insurance Commissioners, issued Actuarial Guideline 49, which limits the maximum illustrated rate that can be used in IUL illustrations. Before that guideline, some illustrations were running at 8%, 9%, even higher. The guideline brought those assumptions down. But here's the thing, even 6% or 6.5% illustrated rate applied consistently over 30 years can be wildly optimistic when you factor in years where the cap was hit. Years where credits were near zero and ongoing insurance cost increases. The most honest thing you can ask an agent to show you is a stress-tested illustration, and that means, what does this policy look like if credited rates average 2%, below the illustrated rate for the entire period? What happens if cap rates are lowered by the insurer in year 10? What does the policy value look like at age 75, 80, 85, under conservative assumptions? If those stress test numbers still make the product attractive for your situation, that's actually meaningful. That's a policy you can have genuine confidence in. But if the conservative illustration shows the policy lapsing in your 70s, you've just learned something that could save you from a serious mistake. After all of that, let me be direct about who an IUL can genuinely be a strong fit for, because used correctly, it is a legitimate and powerful tool.
Nice.
You're a strong candidate for an IUL if you are between 30 and 50 years old, young enough that the rising cost of insurance won't become a problem before you've had years of compounding growth. You're a high earner in the 32% tax bracket or above, where the tax income advantage in retirement is genuinely meaningful. You have a need for life insurance anyway, meaning a death benefit deserves a real purpose for your family regardless of the investment component. You can commit to funding the policy aggressively and consistently for 15 to 20 years minimum, not reducing premiums when times get tight. And you're working with a financial professional who structures the policy to minimize the death benefit relative to your premium, which keeps insurance costs low and maximizes cash value accumulation. An IUL is probably not right for you if you're over 55. The rising cost of insurance compresses your runway significantly. You're primarily motivated by the investment return and you don't actually need life insurance coverage. You're not in a position to fund it consistently and aggressively, or you're being told it can replace your 401k entirely. It can supplement it for high earners in specific situations, but it's not a replacement for tax advantage employer plans, especially ones with matching contributions. If you're ever in a meeting where someone is presenting an IUL, whether you're seriously considering it or just listening, here are 7 questions that will immediately tell you whether you're dealing with someone honest.
Can I ask you a question?
Sure, anything.
Number 1. Can you show me this illustration at a credited rate 2% lower than what you're showing now? An honest agent will run it without hesitation. Number 2. What is the maximum cap rate this policy has ever paid? And what is it right now? If the current cap has dropped from its historical high, that's an important context. Number 3. Can the insurance company lower the cap rate in the future? And have they ever done so on similar policies? The answer to both is yes. Make sure they say so. Number 4. What are the total internal charges in year 1, year 10, and year 20? Broken down. Get the cost of insurance and all fees itemized, not bundled. Number 5. What happens to this policy if I miss premium payments for 1 year? 2 years? Make them show you the impact on the illustration. Number 6. How are you compensated if I buy this policy? A direct and apologetic answer to this question is the baseline of trust. Hesitation or deflection is a red flag. And 7. Are you actually licensed in the financial industry? If the answer is anything other than absolutely, walk away. These questions don't take long to ask, but the answers will tell you everything you need to know about both the product and the person selling it. IULs are not a scam, but they are complex product in an industry with misaligned incentives. And that combination has burned a lot of people who deserved better information before they signed. The good news, the product itself isn't the problem, and you just closed a big part of the gap. If this video helped you, hit like. It genuinely helps more people find this content who need it before they make a decision they can easily undo. Subscribe for more honest breakdowns of financial products every week. And if you want to compare the IUL direct to an annuity, which is often the real decision people are trying to make, that video is linked right here. Watch it next and you'll have the full picture. Finally, if you're serious about improving your financial future, I'll leave my calendar link below for a free 15-minute consultation. We'll identify opportunities and build a customized blueprint based on your goals. Serious inquiries only. See you in the next one.